In this presentation, we will compare and contrast present value and future value just to get a better idea of present value and future value. We're going to have the data in the white cells. We're going to enter our data, our answers, into the blue areas up top and down below. Once again, our goal is to just look at that relationship. Obviously, the present value, future value are related. We're looking at the time value of money. So let's get an idea of those relationships with the Excel formulas. The two formulas we want to know are the present value and the future value. We're going to use the same function for the present value of one, present value of an annuity. Therefore, if we know the present value formula of one and an annuity, the one formula for both the present value of one and present value of annuity and the future value for both present value of one and present value of annuity, we can in essence just know those two formulas and then the relationship between them, and we can get a lot of use from that information. So here's going to be our data. We've got the amount up top, we've got the number of periods, we've got the rate, and now we're going to figure out the present value with that data. And then we just want to think of that answer, the present value answer that we get, we're going to use to then calculate the future value just so we can see the relationship between these formulas, these amounts. So let's see what we're talking about here. Let's run the present value formula. I'm going to do that with a negative, and we're going to say present value. Double click on the present value. We're going to select the rate, and then comma. The number of periods, which is going to be 5. Remember, these are years, and we're going to say comma. The payment amount is going to be 0, because remember, this is a present value of 1. Rather than an annuity, the payment would be for an annuity, comma. We're going to say the future value is going to be that 10,000. So we're going to bring that future value back to the one-time amount, 5 years. So it's 10,000 in the future. What would it be in today's dollars? Select enter or hit enter. That's going to be the 4,972. So in other words, 5 years later, if we used 15% as the discount rate after that 5 years would be in present dollars, 4,972. Now we're going to use that 4,972 and put that into our future value formula. So we're going to say this is the present value, and we're going to have the number of years, 5 years, the rate, 15%. Let's calculate our future value, the other formula that we're taking a look at within Excel. This is going to be negative future value, FV. Double click the future value. We're going to take the rate, which is 15%, comma, the number of periods, 5 years, comma. We don't have a payment because we're not talking annuity here, comma. We want to take the present value. In other words, this is today's dollars. How much would be equivalent for an amount 10 years or 5 years out? And that would be, of course, the 10,000. So you can see a relationship, of course, between these amounts. You can better see the relationship between these amounts, or another way to see the relationship between these amounts is to run basically a table to calculate each year. So if we were to do that, we'd say, okay, what if we took years 1, 2, 3, 4, and 5, and then we had the total, and then we picked up the starting amount, and we're going to say, okay, this is the present value. Let's start with the present value amount, and then let's increase it by 15% each year. So that means each year we're going to basically increase it by 15, and that means we're going to have the 100% plus 15%. So therefore the rate is going to be this 15% plus 115, or 100% plus 15%. And then let's say, okay, well, what would happen after in year 1? So this should be 1, 2, 3, 4, and 5, and we don't need a total. So after year 1, we're going to say this equals the prior period, the 4,972, times 115%. In other words, the 15% plus the 100% that's already there, 1.15. And that'll give us the 5,712. Then we'll do this again. We'll say, okay, here's the 115%. Let's take the 5,715 times the 115% for year 2. That leaves us with 6,575. Okay, let's do it again for year 3. This equals the prior number times 115%, giving us 7,562 for year 3. Now let's do this again. We're going to say this is the prior number times 115%, 8,696, same number here. And then one more time, prior number times the 115 gives us the 10,000. So you can do a calculation like that. We could see the relationship between the present value and the future value, getting a better idea of it. Another way to consider this is to use Goalseek to find some other area. Goalseek going to be a function that we can use within Excel. So let's take either one of our data here, our data set, and let's say that we're going to solve for the rate. So I want to solve for the rate and say that that's going to be the unknown rather than in the first case, the present value. So if I'm going to solve for the rate and I'm going to use Goalseek to do it, what I'm going to do is I'm going to guess the rate. I'm just going to pick a rate at random. Then I'm going to use the present value formula. Then I'm going to say, hey, Excel, would you use Goalseek to figure out what the rate should be to get the present value to know what I know that it should be. So we know the present value is going to be the 4,049.72. I don't want to plug it in here. I want to use a formula to do so, however, and I want to enter a rate just to start off with so I have some value for the rate. So I'm going to say, all right, what if the rate was, 2%? Let's put in our present value formula. This equals, or let's say negative, present value. Double click the present value. We want the rate, 2%, we just guessed. That's just a guess, comma. Number of periods, 5 years, comma. The payment is 0, comma. And then the future value we're going to say is 10,000. Now, when we say enter, we're hoping it's going to be 4,972. It's not, because we just guessed this rate. Now, we could try to figure out, okay, what would this rate be to get this to 4,970? What if I chose 4%, right? And we could keep doing this. It's getting closer. Let's go ahead and let Excel do that. We'll do that by going up top. We're going to go to the Data tab up top. We're going to go to the Forecasting section. We're going to go to the What If analysis and go to Goalseek. Goalseek. Now, we don't have to be on any particular cell here to use Goalseek. We're just going to say, all right, Excel, this is what we would like you to do. We'd like you to set this cell to be what we know it should be. Set it to the value of 4972. I want you to do that. We'd like you to do that by changing this cell. So let's review that one more time. We're saying, hey, Excel, we know what this should be. It should be 4,972. Change this cell, B24, to 4,972, please, by adjusting the related cell that's in a related function, a related formula, this rate, this 5%. Just do whatever you got to do to make that 5%. And Excel will actually test everything to figure out what it should be. So we'll say, okay, and then say, 15%. There it is. So now we have that 15% as our answer. We can do a similar type of calculation. What if we said that this is going to be our present value amount, and now we use the future value formula to figure out the rate? And we're just going to use the Goalseek in the same format. So we know the future value has to be 10,000. That's going to be the future value, but we don't know what the rate is. Let's pretend it should be 15%, but we don't know that. So we're going to do the same thing. Like, what if I guessed a rate? What if I said, well, I think it's going to be 25% on the rate? I don't know. And then use future value to figure out what this rate should be. So now we'll use the future value formula, same kind of Goalseek analysis. We'll say, all right, negative future value, double click the future value. We want the rate, which we don't know. We just entered a random number, comma, number of periods, 5, comma, and then the payment amount is 0, comma, and the present value is the 4972, and enter. Now again, we want it to be 10,000. It's not, so we're going to have to change this 25. How about we change it to 24? That's better. How about 20? So we need to go down a lot. Let's let Excel do that. I'm going to put my cursor on any cell to use Goalseek, and we'll go to the Data tab, Forecast, What If analysis. We're looking for the Goalseek. And then we're going to say, all right, Excel, we want you to set this cell to be 10,000 by doing something to this cell. In other words, do whatever you got to do to the 20%. So let's take a look at that one more time. We're saying, Excel, we'd like you to change this cell in B30 to 10,000, the value, by doing whatever you need to do to this cell, which we know is wrong. We just want you to keep testing numbers till you find something that makes this thing be 10,000. So we'll say, okay, and it just tries everything, says 15%, that's the one. So that's another way we can test this. We can hopefully give us an idea of the relationships between present and future value, the two formulas, and how they're related. And we can use Goalseek under either condition if we don't know basically the percentage. That's one format and one tool that's going to be very useful to use. What you really want to know in Excel is you want to know the present value formula, you want to know the future value formula, and you want to know the difference in calculating them between an annuity and a single value. So therefore, you only need to know those two functions, but you need to know how to use them for a present value versus an annuity. If you know that, then you're pretty good, and you can solve a lot of other problems, including if you don't know the interest rate and you know everything else, and you don't know the amount possibly or the number of periods. Any one factor that you don't know, you can then use Goalseek to kind of figure out what the missing component will be. So the present value formula is very important to understand.